Welcome back to Small Caps. My name's Kerry Stevenson, and pretty excited today, ladies and gentlemen. I am talking not one, but two. I've got the chairman and the managing director of Lake Resources. Now, if you haven't heard of Lake Resources, you must be sitting under a rock. They have a very large lithium project in Argentina. The ASX code is LKE. Write that down, because what we're going to talk about today is going to knock your socks off, but do your own research, as you must always do. Welcome to Small Caps, Steve Promnitz, Managing Director, and Stu Crow, the Chairman. Good to see you both. Look at us.
Thanks,
we're all in the corporate colours with our blues. I love it.
Yeah, well done.
Before we get started, for anyone that was under a rock recently, Steve, can you just give us a very brief overview of who are Lake Resources?
Super. Thank you very much. So Lake is in the lithium space. Lithium is basically divided between hard rock and brine. We're on the brine side in the lithium triangle in South America, in Argentina. We've got a full suite of projects, 4 different projects covering a very large area, 2,200 square kilometers. I'm going to be talking about our flagship project, Kachi, large resource, 4.4 million tons. To break that down, that's 25 years of production out of 20% of the resource. We're just south of the producer that's been there for the longest time, Livent. Their ticker code is LTHM on New York Stock Exchange. And we are using something different to other brine producers, which is direct lithium extraction. The benefit of that really comes in 3 key things. 1, we produce a consistent high quality product. 2, because it's a high quality product, we get a premium price, so a big healthy margin that's then scalable. And then 3, we get an ESG benefit, small carbon footprint, small land use, small water usage, and that is actually the key driver that gets electric vehicle makers wanting to talk to us and see this product in their supply chain.
That ESG benefit that you just mentioned, why is that so much a part of it? Is it because of the direct extraction method? Where does the ESG benefit come in? Explain that a little bit more.
So what traditional brine producers do is they pump this brine, which is just a salty water, and dissolved in it is lithium. And they put that in these ponds, and the sun evaporates the water away. You concentrate all the salts, and then you take the lithium and put that into lithium carbonate. What we do is replace those evaporation ponds with a whole series of modules. It's very efficient. It happens in the space of 2.5 to 3 hours instead of months or years. But because you just take the lithium out of the water instead of concentrating all of the salts, you, by that very fact, you produce a high quality product. And then instead of having 15 or 20 square kilometers of evaporation ponds, you've got a plant the size of 1 or 2 city blocks. And so the land footprint is smaller. And because we just take the lithium out of the brine, which is less than 1% of it, we can return virtually all of that water back to its source. So it's got a low water impact, and all of the brine producers have a small carbon footprint. Now, those 3 things are actually almost the first step when you're talking to battery makers and car makers in the European Union, because they have to meet very stringent environmental measures going forward, particularly carbon measurements. And so we're at the forefront of that because of using this direct extraction process.
If they're doing the evaporation process, some of your, it's not competitors, but others in the lithium space, is there an ability for them to turn that around and do what you're doing? Or are they stuck with doing evaporation and that's just the way they're going to go? I guess what I'm looking for is, where are you just ahead of the curve, or are the other people in lithium stuck where they are with that extraction method, which is not ESG friendly?
Okay, so there's 2 things there. So we started down this path of direct lithium extraction more than 3.5 years ago, because we defined a large resource at Kachi, but we said all of the off-takers, all of the battery makers are saying we want a consistent high quality product. And you can't get that using the traditional method. So that's why we went down this path very early on. It's always easier to build a plant from day one if you've got a new technology and build it from the ground up. So we're both ahead of the curve on direct lithium extraction, and also we can build this in the ground up the right way. So the second answer to that question is, it is possible to retrofit And you could potentially, and there are a number of different ways of direct lithium extraction, you could potentially retrofit this, but anybody who's been in this game in any sector knows that retrofitting is potentially fraught with issues. It's not straightforward. So yeah, we're both ahead of the curve, and I think we're going to be able to build a better project from the ground up.
Well, recently you've just announced some project finance for Kachi, and that was with the UK, if I get this right, Export Credit Agency. That's a big deal, guys, isn't it? Because, you know, we've spoken about this before, that in order to get a project going forward, you've got to have debt and equity and offtake. So how big a deal is this for you? I mean, are you guys pretty excited about what they've done? And explain to those listening that may not have seen this announcement, because I think it's a pretty big deal.
If I could break it down like this, I have rarely seen a project get debt financing before they've finished their final feasibility study. And secondly, we're getting this where they're saying, not only are we going to finance this as long as you do what you say, but we'll even finance your expansion. Yeah. That's almost unheard of. So, you know, I want to, sorry, I want to get a...
You got to put it in front of your face, Steve.
That's
there you
it.
go.
There we go.
He's got his Harrods cup. So we love the POMs.
It really is remarkable. So how does export credit agencies work, first of all?
Yeah.
Their whole idea around trade finance is to be able to get both equipment and technology or services from that particular jurisdiction, in this case, the UK. And we've had this offer out to a number of export credit agencies, and we reasonably expect that we'll probably have some others joining in. But essentially, the UK Export Finance has said we can do the lot, up to 70% of your total finances required.
Which is how much, Steve?
For the 25,000 tonne per annum, our phase one is 544 million US. And then an expanded plant, we will come out with those numbers, but you could think of some number around maybe 850 million. We'll see where that number is. Okay. And they're good for 70% of that. Secondly, they've also said that they will guarantee the political and commercial risk insurance. And so that means that the panel of banks that come behind them, because we're talking to about a half a dozen international banks, they essentially have their debt guaranteed. And so they can offer it out at sort of LIBOR and a few bips over that. Okay. Possibly something around 3%. That's almost unheard of. For a company like ours, we'd be looking at least 15% plus. It means that our cash flows look a whole lot stronger. We don't have to source as much equity. But best of all, it basically says, guys, wake up. The world is moving through this whole energy transition. Yeah. It needs all of these battery materials. And the reason that we've got this backing is, here's a good project that can scale up with an ESG benefit that's actually tangible and measurable. So all we basically need to do is the bread and butter things, finish our definitive feasibility study, our environmental social impact assessment. That's targeted for Q1 next year.
Okay, sorry to interrupt you, Steve. I just need to ask you, the DFS is first quarter next year, environmental impact, same sort of time?
Same sort of time, or maybe a month later. It's in that timeline. And we'll be pretty much ready to go. Because the other thing is, we're doing other things that we'll probably talk about, bonus options and options we issued back in January to the fundraising then are being converted. We could easily look at between 50 and 80 million in the bank come the end of October, early November. So we're not far off about having the whole thing totally financed. And then one of the questions I regularly get is, oh, what about the offtake? Now, I think I mentioned on one of our earlier interviews 2 or 3 months ago, look, we could have signed up 5 different offtake agreements for the first 5-6 years production. One of the reasons we're going to an expansion is because that demand is there, but the field has broadened somewhat in the last 6 to 8 weeks. And so we just want to get both the right party as well as the right terms. And we'll probably announce one of those before the DFS and one about the same time. And then we're off to the races.
Well, I tell you, it's a very, very exciting time for you guys. Stuart, as chairman, I know that you guys, both of you have, this is not something that's happened just overnight. There's been 4 years of solid work behind the scenes, and I know 5, is it? 5.
Yeah.
Okay, 5 years of solid work, probably, and a few grey hairs. Oh, yes, a few out there. I want to talk. We've talked about the finance. You've announced an issue of bonus options to shareholders. Can you talk us through that, Stu, and what that means, why you've done it, I guess?
Sure.
Because a lot of people that I've spoken to, sorry, just before you start, have said it's had a good run, it's probably going to run out of steam. So I want to talk about options, and then I want to talk about current share price.
Absolutely. You're right. We have been doing this for, it seems, a while. The last 2 years I described as the valley of death, where equity markets were closed to these sort of projects. We were struggling to keep the money coming in and to keep the progress, the projects progressing. Yeah. And we were down to our last sort of friends and family with our last capital raise before we did that big one in January. So it was not easy. And we had a lot of loyal shareholders that stuck with us through that period and actually contributed to those smaller fundraisings that we were having to do just to keep the whole momentum going toward delivering this DFS. We had an institution that was all lined up to help us fund the DFS a year ago, and we went straight into COVID, and that fell away. So we missed, literally by a matter of weeks. In which case, by now we would have had the DFS completed. But that's life. So it was difficult, and we pushed through, and now we're sort of reaping the benefits. We're getting a growing awareness, but those options particularly were to say thanks to the shareholders for supporting us through those tough times, and to give them, they didn't participate in the issue we did in January. That was done purely by an American group who raised the money mainly out of the US and Europe, and we'd had a couple of Australian institutions in Acorn and Ausbil join that raise, which was fantastic, and that started the institutional presence on our register. But the retail and our shareholders missed out on participating. So we wanted to do something to say thanks for hanging in there with us, but also it also tops up our bank. And it's interesting now that we're getting increased awareness as the sector moves on. We've had a lot of people approach us with funding deals and things, and we don't need the money right now. So we want to see this stock revalued and demonstrate the value that we've created for our shareholders. And then at that point between now and June next year, where we need the money to match up the equity component with the debt that we've got the expression of interest for, I feel very confident we'll be getting that at a significantly higher price than where we're currently trading. So remove of our capital raise, which we're getting pestered with people saying, oh, you need to raise money, you need to raise money. Well, the shareholders, I'm certain, will support through those options expiries, because don't forget, we had one of those previously, the last exercise price at 10 cents in June, when the stock was trading around 35 to 40 cents. So shareholders did really well out of that one, and I suspect they're going to do very well out of this one.
Fantastic. Well, you talked about the share.
The other thing is that's non-dilutionary, because it goes out to all shareholders. So all shareholders can participate. So it's not like we go and raise money from a bunch of financial institutions and all our existing shareholders get diluted. All our shareholders get a participation in this. So it's a much fairer way of raising money before the big money.
Yeah, that's good. And you're looking after those people that have been very loyal over the years, because I do remember back in the day when it was a 4-cent share, and it was tough, guys. It was tough, but you held on and said, you know what, we know, because I think in the early days there were people that actually didn't quite believe that this new extraction method was actually going to work. It was all poo-pooed a little bit, and it was all like, no. Direct extraction won't work. It's all about evaporation. But now we've proved it works.
Mad.
And now people are seeing the benefits of not just ESG, but cost-wise, etc. But I want to bring up this to you guys. Standard Lithium, which is, I think, on the New York Stock Exchange, have got a share price which is
fantastic,
kind of a lot bigger than yours at the moment, and Vulcan's pretty good as well. What do you think is the difference between the projects, and why are they forging ahead? And I mean, like, by the way, guys, you've done really well. I'm not taking that apart. Your share price has done extremely well over the last 12 months, but the others seem to be rated in a different atmosphere. What do you put that? That's to either of you.
Yeah, I'll have a crack at Standard. And Standard Lithium are good mates of ours. Rob Mintak and Andy Robertson, they've done a brilliant job delivering that project at Smackover, which is treating a tail brine from Lanxess in their bromine operation and extracting the lithium using direct extraction, not the same as ours, but a similar process or similar, as they're not evaporating. So they're using a similar process to extract the lithium and re-inject the brines. Okay. They've done a remarkable job. They were ahead of us. They're probably 6 to 9 months ahead of us. They're in North America, so that's been perceived as an advantage. They've got a big partner in Lanxess, which was a spin out of the Bayer AG chemical business. They're a multi-billion-dollar partner, so their funding is pretty secure. We haven't had that, clearly. The last few years, we've proven that. We've been scratching around, raising $1 million here and $1 million there. Those guys would just get more money from Lanxess so they could keep it moving. The difference is, and you're right, they're trading now. They've got a market capitalization somewhere around $4 billion US. That project has, I should say. Standard Lithium own 30% of that project. We currently own 100% of the Kachi project and 100% of 3 other lithium brine projects in various stages of development. So we think they've done a great job. We think that stock, they're going to produce 20,000 tonnes in their PFS. Our PFS is for 25, and we're now talking about doing a study to bring that to 50. So we would like to think we're on a similar trajectory to Standard, and it's simply a matter of growing the awareness of what we've got and what we're looking to deliver. Firstly, at Kachi, but think about this, Kerry, with 3 other projects in brine in and around existing operating projects in Argentina, and some big names like Orocobre and Lithium America with Ganfeng support. We've got 3 projects there, and we've done 4 years of test work. We know this stuff works, and we're very confident it works. And to go out and bring these other projects online, because currently I don't know that they're valued at much by the market, but it's certainly our intention to demonstrate that they are very valuable assets and look to, in parallel, without distracting from getting Kachi up and running, but do a fair bit of work building resources across those other projects in the next 6 to 12.
Would you consider listing on another exchange like the New York Stock Exchange?
Absolutely. Yeah, we have. And yeah, we have, and we've done a fair bit of work on that. And, the opportunity there for us, we're on the OTC currently in the US, but to uplist, as they call it, to either NASDAQ or the New York Stock Exchange is something the board has talked about, and we're yet to make decisions there, but it just makes sense given the scale of the capital pools that are available.
Yeah, and that's what I was thinking. The scale of capital over there it's just a very different marketplace, isn't it? And also just to get yourselves noticed over there as well with some of those big funds would be pretty interesting. Yeah. Steve, you look like you wanted to come in and say something with that.
Yes, indeed. Don't forget that our technology partner, Lilac, is California-based. Right. And they have backers from the tech sector. So I think that also will increase our appeal in that sector. So it's not just a lithium story, and it's not just an ESG story, but there's also that clean tech and tech angle to it. And it's a key differentiator. It's certainly something that we're looking at seriously before we complete the final investment decision and move ahead with construction middle of next year.
What do you say to those people out there that are saying, well, lithium, it's great, it's on a roll at the moment, but there are going to become other like sodium batteries, I think it's sodium-ion batteries and things like that. What about other newer technologies? Is that a concern for you at all, a couple of years out?
So the short answer is no. As a matter of fact, if there are some new technologies coming along, that would be good. But if we just look at the here and now, we've got 225 battery megafactories that have been announced, of which 151 will be producing by the end of this calendar year. They are all designed to be producing lithium-ion batteries. So That is quite a significant amount of batteries just in and of itself. If that 225 megafactories do in fact all reach full production by the end of 2030, we need 10 times the amount of lithium we produced last year. UBS forecast that of all the projects that are coming on stream that could potentially appear, maybe we'll get to 25 or 30% of that target.
Wow.
So we've got a long way to go. If I could put it into simple terms, we would need 50 projects the size of Kachi over the next 10 years. And they're just not around.
Yeah.
Moreover, we've seen M&A happening in Argentina, as well as in other parts of the globe, headed up by China Inc. and Gangfeng. And so the uniqueness of an independent producer that has got real scale, a number of projects producing a high margin product that also has an ESG benefit, that puts us in a very rarefied space and something that the end users want to see and have to have in their supply chain.
We are running out of time, but I've got to ask this question, guys. How do you protect yourself? You just said it, Steve, you're an independent. How do you stay away from somebody coming around and going, we're going to take you out?
Any good company should always be a target for that sort of corporate activity. One of the other benefits of a bonus option is to say to the shareholders, don't let this thing go for nothing. Pile in here. Let's follow this story, because we've got the potential to be in the top 4 lithium producers and producing a product that is pretty rare in that ESG space. There will be a rush. We will see other direct lithium extractions. We will see, as you mentioned, some retrofitting into current operations, but we can go straight out through the front door with something that the market needs right now and needs over the next 5 to 10 years.
All right, so I've got to ask this as well. Final investment decision, and when do you think you'll be producing? What's your time frame for that?
So at the moment, that is scheduled for the middle of next year.
Oh.
Look, it might be a couple of months after that, and still targeting first half of 2024 for the 25,000 tonne per annum production. Because of the interest in that expansion to 50,000 tonnes per annum, it's probably a couple of years after that. And we just got to work out if the second train is going to be hydroxide or carbonate. It's pretty exciting.
Yeah,
I can hear your excitement. And Steve Promnitz, you're normally quite, conservative, etc., but I can feel the excitement with you at the moment. So, yeah, it's a very interesting story. Stu, any final comments from you?
Well, Kerry, some people have said, it's getting very expensive now. You were 3 cents this time a year ago. Now you're 60. Is it getting overvalued? Well, I think when you compare like for like of what we're talking about producing here and the quality we're producing and the margin that we're creating and the expansion opportunity across 3 other projects on top of Kachi, I think we've got a long way to go. So, when we talk of Standard Lithium and the valuation of Orocobre that produces 12,000 tonnes a year, I think we're cheap, and I have to say that I'm the chairman. So it's, but I honestly believe that, and I think we will see, if we come back here in 6 months' time, we will see a completely different company that's accepted and has a growing awareness across the international financial markets. And we're already seeing interest from global investors who are active in the market and looking for opportunities to get involved. So it's very
the numbers were interesting. If I can just point those out to our listeners, is that your market cap at the moment is about 500 mil. Standard Lithium is about 4 billion. You've got 100% ownership of your projects. They've got 30% of theirs. You kind of do the maths and scratch your head and go, yeah, okay, there's a long way to go.
Yeah, if I could simplify it, we're trading 25, 30% of our NPV of one project.
Yeah,
nicely said.
And that's without the expansion to 50,000 tonnes. You put that in, this thing looks ludicrously cheap.
Yeah,
love that. Love that. Ludicrously cheap. This is not financial advice, ladies and gentlemen. Do your own research. Obviously, we have the managing director and the chairman of Lake Resources talking to you today. But again, Standard Lithium, I just did the numbers for you. And one of the things that I will say, it's about management. These guys have done a lot of the hard yards. As I said before, I said 4. They reminded me. It's actually 5 years. They've done the hard yards. Hope you enjoyed this story. Steve, Stu, thank you so much for joining me on Small Caps today.
Thanks, you.
Great. Always great.
And also just a call out to our team in Argentina. We couldn't have done this through COVID without them. They've been great. And it really is a credit that we can actually be operating during COVID and still doing all of this stuff and now looking to move into the construction phase. So thank you to the whole team.
Oh, very good point. Yeah, we didn't bring that up. Go the Argentinian team over there. And if you're watching this, the boys love you. So keep going.
Yep.
Cheers for now.
Thanks, Kerry.